$25 million in Google stock just vanished overnight, and no one knows why. But here's the thing, this wasn't a hack, a glitch, or financial fraud. It was completely legal, and what happened to that investor could happen to you, but in reverse, meaning you could be leaving thousands of dollars on the table every single year without even realizing it. Let me explain what I'm talking about. Most people know about individual retirement accounts, or IRA. They know you can contribute $7,000 per year if you're under 50 years old, and $8,000 if you're 50 or older. That's the basic knowledge floating around financial forums and retirement planning websites. But what 99% of people don't know, and what financial advisors often don't advertise because it reduces their billable hours, is the spousal IRA loophole that could literally double your retirement savings each year. Here's how it works in its most basic form. If you're married, your spouse can open their own IRA and contribute the full $7,000 annually, even if they don't earn any income. That means a couple can contribute $14,000 per year instead of $7,000 over 30 years, assuming a 7% average annual return, which is conservative based on historical S&P 500 performance. That's the difference between having $765,000 and $153 million sitting in tax-advantaged retirement accounts. We're talking about potentially $768,000 in additional wealth, completely tax-free. But wait, it gets better. Let me walk you through exactly how this works, step by step, so you understand why this is such a powerful strategy that the wealthy have been using quietly for decades. The first requirement is simple. You must be married and file a joint tax return. That's it. Your spouse doesn't need to have any earned income whatsoever. They could be a stay-at-home parent, a full-time student, or someone who left the workforce to care for elderly parents. The IRS allows this because they understand that married couples are financial units, and there's a legitimate argument that even a non-earning spouse contributes economic value to the household. Let me give you a real-world example. Sarah and Michael are a married couple in Colorado. Michael is a software engineer making $120,000 per year. Sarah left her job 5 years ago to raise their 2 children. Under traditional IRA rules, only Michael could contribute to an IRA because only he has earned income. But with the spousal IRA loophole, Sarah can open her own traditional or Roth IRA and contribute the full $7,000 annually. Michael contributes $7,000 to his own IRA. That's $14,000 per year going into tax-advantaged retirement accounts. After 25 years, until retirement, assuming that 7% return, they'll have accumulated approximately $787,000 just from this strategy alone, money they wouldn't have had otherwise. Now let's talk about the mechanics of actually setting this up, because there are some important details that trip people up. First, you need to have enough earned income as a couple to cover the contributions. If Michael makes $120,000 and wants to contribute $14,000 total, $7,000 for himself and $7,000 for Sarah, that's fine because $14,000 is less than their household earned income of $120,000. But if Michael only made $8,000, they could only contribute $8,000 combined, $4,000 each, roughly speaking. The IRS won't let you contribute more than your combined household earned income. Second, there's an important distinction between traditional IRAs and Roth IRAs when using the spousal strategy, and this is where many people make expensive mistakes. With a traditional spousal IRA, your non-working spouse gets an immediate tax deduction for their contribution. So if you're in the 22% tax bracket, that $7,000 contribution saves you $540 in taxes right now. With a Roth spousal IRA, there's no immediate tax deduction, but all future growth is completely tax-free, and you can withdraw contributions penalty-free at any time. Let me break down which one makes sense for different situations. If your family is currently in a high tax bracket and you expect to be in a lower bracket in retirement, a traditional spousal IRA makes sense because you're saving taxes at your current high rate, then withdrawing at a lower rate. But if you're currently in a lower tax bracket, or if you're young and have decades of compound growth ahead, a Roth spousal IRA is almost always superior because you lock in tax-free growth for potentially 40+ years. Here's a case study that illustrates this perfectly. Jennifer and David are both 35 years old. Jennifer works as a marketing director earning $95,000 annually. David runs a small freelance consulting business that nets him about $3,000 per year, hardly anything. For years, they thought David could only contribute $3,000 to an IRA because that's his earned income. But their CPA finally told them about the spousal IRA strategy. Now, Jennifer contributes $7,000 to her Roth IRA, and David contributes $7,000 to his Roth IRA, for a total of $14,000 per year. Over 30 years until they turn 65, assuming 8% annual returns, they'll have approximately $173 million in their Roth IRAs. Compare that to the original scenario where David could only contribute $3,000 per year. They'd have only about $740,000. The difference, nearly $1 million, all of which would be completely tax-free to withdraw. Now let's address the counterarguments and common misconceptions, because this is where people often dismiss the strategy prematurely. Some financial advisors argue that spousal IRAs make sense only if one spouse truly has zero income. They claim if both spouses have good incomes, you should just focus on your 401(k)s and HSAs, but this is flawed reasoning. Your 401(k) contribution limit is separate from your IRA limit. You can do both. You can contribute to a 401(k) up to $23,500 per year as of 2024 and contribute to an IRA up to $7,000 per year. They don't overlap. So a couple could potentially contribute $51,000 per year, $23,500 each to 401(k)s plus $7,000 each to IRAs into tax-advantaged accounts. Ignoring the spousal IRA piece when you're married is just leaving money on the table. Another common objection is the income phase-out for Roth IRAs. If you make too much money, you can't contribute directly to a Roth IRA. But here's where the spousal IRA creates an interesting opportunity. The phase-out limits are based on modified adjusted gross income, and married couples filing jointly have higher phase-out ranges than single filers. For 2024, married couples can contribute to a Roth IRA if their MAGI is below $230,000. That's substantially higher than the $146,000 limit for single filers. Plus, there's the backdoor Roth strategy that works with spousal IRAs, which allows you to contribute to a traditional IRA and then convert it to Roth even if you're above the income limits. This is completely legal and used by high-income earners constantly. Let me walk through one more detailed example to cement this concept. Marcus and Priya are both 28 years old. Marcus is a surgeon earning $250,000 annually. Priya is a freelance writer earning $15,000 per year. According to IRS rules, they have $265,000 in combined household earned income. Now, because they're above the Roth IRA income phase-out limits, they can't contribute directly to Roth IRAs, but they can use the backdoor Roth strategy with spousal accounts. Marcus contributes $7,000 to a traditional IRA and immediately converts it to a Roth IRA. Priya does the same $7,000 to traditional, then converts to Roth. They've just contributed $14,000 to Roth IRAs despite being well above the income limit. Over 37 years until age 65, with 8% average returns, that's over $8 million in completely tax-free retirement wealth. If they had ignored this strategy, they would have zero Roth IRA contributions due to their high income. Finally, let's talk about the often overlooked beneficiary advantages. When you have a spousal IRA and something happens to one spouse, the surviving spouse has several options. They can treat the IRA as their own, which gives them maximum flexibility, or they can keep it as a beneficiary IRA. This flexibility is powerful for estate planning and ensures maximum control over your retirement assets. Many couples never consider this angle, but it's genuinely important. The bottom line is this: if you're married, you're almost certainly leaving money on the table if you're not maximizing spousal IRA contributions. We're talking about potentially 6 figures over your lifetime. The strategy is legal, simple to execute, and available to virtually every married couple. It requires no special knowledge, no complicated investments, and no excessive risk. It's one of the few remaining wealth-building loopholes that the average person